cover today is looking good during these very difficult, downright ugly financial times. And a buzzword that you're going to hear quite a bit is diversification. And that if you have a diversified portfolio, this is going to help you through the difficult parts of these difficult financial times. When we talk about diversification just for the sake of diversification is not a winning investment strategy, in my opinion, and mainly because of the risk that you take. There's an awful lot of money that's wrapped up in 401ks for retirement, obviously 529 plans. And there's a lot of different places that money tends to be placed and just stay static. It's not actually being moved, as Ryan has discussed, to current market environments. So what happens is you get these static portfolios that have some percentage of stocks, some percentages of bonds, and some percentages of cash. So, a typical moderate portfolio will be about 50 to 60% cash, or 50 to 60% stocks, and about 40 to 50% bonds, okay? And they're just going to hold that. And it's going to literally look like a glass of oil and water with, you can call the water the bonds and the oil on top the stocks. And they may have some alteration over the long run. A perfect example of this is target date retirement funds. When they say, oh, if you're planning to retire in 2035 or 2045 or 2050, they're going to have inside those portfolios, they're going to have percentages that are allocated to stocks, bonds, and cash. And they become more conservative, more in bonds, more in cash as you get closer to those target dates. There are also generic risk funds that are out there. This is very common in 529 plans, in the fact that you can buy a growth fund, you can buy a moderate fund, you can buy a conservative fund. They tend to be static portfolios of a percentage of stocks, percentage of bonds, percentages of cash, depending on your timeline and your risk horizon. Okay, so what's the problem with that? Well, a classic example, if you were looking at Ryan's sector funds, there is one sector, energy, that is positive right now, and there are 11 negative. As he was even putting it, utilities, which you would think most people are paying their utility bills, very safe, very secure. These companies are going to make money because people want to keep the lights on, keep the water flowing, and have electricity. It's amazing. I think part of the reason that sector is down right now is because there are so many people that are watching their electric bill double, that they are having a really, really hard time keeping up with the bills, which is, I think, an inflection of what's happening in utility companies right now. Obviously, price of oil, and when you have 2 million barrels a day cut of supply, oil and gas companies, that the production they're going to be making more money off of that, which is why energy is up at this particular point. But if you're sitting there with a static portfolio, you're sitting there, you may very well own all 12 of those sectors, regardless of whether or not they are a good place to have your money or not, particularly in regards to your risk and your timeline. There are benefits to diversification in the fact that when the economy is good and you have rates that are declining and an economy that is growing, you're going to hit on all cylinders. Most of these investments, if not all of them, are going to be up, and you're going to be fully participating in that. Another good part of a static, diversified portfolio is they tend to be very inexpensive, right? There's no daily looking at this. It's like, okay, we set the portfolio and we're going to come back to it in 6 months, a year, 5 years. There's no real thinking to it. So literally they should be, and often are, inexpensive ways to invest.